you're not a major shareholder, I mean, you only own 1/750 millionth of the company. When you're investing in real estate, you have to be thinking for the next 10 years because you cannot move the property's location. Everybody's gonna be using cryptocurrency and Bitcoin, and if I can come in now. What's up, everybody? I am Jaspreet Singh from theMinorityMindset.com, where money minds rethink rich. Becoming wealthy is one of those things that everybody wants, but none of us are taught how to do it. That's why in this video, I'll put together some of our best clips that will walk you through the things you need to know to become wealthy. So let's get into it. When most people talk about where your money needs to go, they give you a flow chart of what you need to do with your paycheck. So they say, okay, you just got paid from your job. Now some of your money needs to go into your 401k. Now whatever's left is gonna go into your checking account, and out of your checking account, some of this money is going to be invested, some of this money is going to be saved, and some of this money is going to be left over for you to spend. I've already talked about what you need to do with your paycheck as soon as you get paid. So if you want to learn more about this, I will link that video for you in the description below. But in this video, I want to go a little bit deeper and talk about where your money needs to go to develop you and your finances. There's a lot more to life than money, okay? Now, this doesn't mean that money isn't important or that money doesn't matter. Anybody who tells you that money is important or money doesn't matter is either broke or delusional, because it costs money to eat and it costs money to feed other people. But you need to know how money plays a part in your life. This is my quadrant theory. If you're subscribed to our YouTube channel, you've heard me talk about this before. If you're not subscribed to our YouTube channel, you should probably do that. But this kind of lays out the 4 different aspects of our lives. You have the physical aspect, the mental aspect, the spiritual aspect, and then finally, the financial aspect. If you want to live a happy life, you need to be fit in all 4 of these things. You got to be healthy in all 4 of these areas if you want to be able to live a good life, and you want to start by being physically fit. Now, when I say physically fit, I don't mean that you have to have a 6-pack. I mean, you got to be physically healthy. If you are morbidly obese or you're on your deathbed, it doesn't matter how much money you make. You got to be physically healthy enough first to be able to live your life. Then you gotta be mentally healthy. If you are struggling with depression or anxiety, or you're not happy, or you don't have people that you love around you, it is very hard to be happy. And if you're not happy, it doesn't matter how much money you make. More money is just gonna make you more miserable. After that, you gotta be spiritually fit. When I say spiritually fit, that doesn't necessarily mean religion. That means having a purpose in life. Why are you on this earth? What are you getting up to do every single day? You need to have a purpose for why you need to get out of bed every single day. Then, once you're physically fit, mentally fit, spiritually fit, this is where being financially fit comes in handy, because now you have money to amplify your life, and this is where you gotta know how to spend your money, and you need to know where your money needs to go. Then, at the tippy top, do you see that right there? The last thing you gotta do is smash that thumbs up button below. That last part's optional. So when you have money, there's 10 places that your money needs to go, and these are in no particular order. First, some of your money needs to keep going back into your mind and developing yourself. Growing up, I was never a fan of reading. English is my second language, and I struggled in English class, and so I never liked reading books. The first books that I ever read cover to cover were business books, but even that was kind of hard for me because I've always been a slow reader. That's when I found out about audiobooks, but this is before Audible was a thing, so I used to listen to audiobooks on CD, and I still have a copy of some of mine. This one is The 7 Habits of Highly Effective People. I still got this one in my office. Most of us don't grow up with parents who are multimillionaires that just teach us how to become wealthy. And so if you don't know anybody who's wealthy or an investor in your circle, what you can do is break out of your circle by reading books, by learning from people who are actually doing it. I used to buy almost every personal development or business or investing audio CD that I could get my hands on, and I listened to it while I was driving, and when I finished it, I would just throw it in my back seat. And so the back seat of my car used to just be filled with audio CDs. Now it's a lot easier because you can just download Audible and have all your audiobooks on your phone. The interesting thing for me about reading books is when you read more books, you become smarter. And the smarter you become, the more you realize that you don't know anything. I like to think that I know a thing or two about finance, which might be why we just passed 800,000 YouTube subscribers. Thank you, you beautiful people. But I also know that I don't know everything, which is why I keep learning and reading more books and taking more classes. There's a quote that really stuck with me on this, and it said that the moment you stop learning is the moment you start dying, which is why you want to keep investing in your mind. Second, spend money on your health. I think it was Warren Buffett who originally said this, but imagine for a second that the day you turn 16, you got your license and you were given a car, but then you were told that this is the only car you'll ever be able to drive in your life. So no matter what you do, you'll never be able to get a new car. What would you do? Well, chances are you're gonna take really good care of this car. You're gonna get your oil changes, you're gonna do the maintenance, you're gonna keep it clean, and you're gonna make sure it keeps driving well, because if it doesn't drive, then you're not gonna ever have a car again. Now, same story again, but this time imagine that you replace the car with your body. You're only given one body, so take care of it. I work a lot, but I am not scared to invest money or time into my physical health. I try to go on a 5-mile walk every morning and go to the gym. At the very least, invest in a gym membership or some equipment so you can work out or exercise every single day. Get yourself some healthy food. Pay a little bit extra if you have to eat healthy. Don't just eat McDonald's all day every day, because this is the only machine that you ever get. I know this is a little bit ironic because Warren Buffett, who gave that original speech, loves eating McDonald's and drinking Coke, but he's an exception to the rule. Make your doctor's appointments, be proactive with your health, and if you don't feel mentally healthy, if you're depressed or you're anxious or you don't feel happy, get that taken care of. Go get a therapist, invest in it, whatever it takes, because if you are not mentally healthy, it doesn't matter what you're doing externally, because you're not going to be able to live up here. Third, on the financial side of things, invest some money into paper assets. This is what most people think about when they think about investing. You're investing your money in stocks or bonds or your 401k or your IRA. All a paper asset means is you're investing in something on paper. You're not getting anything really tangible. So if you go out and you invest in one share of the McDonald's company, you become one of the owners of McDonald's on paper, but you don't get to own a physical franchise. You don't own a building. You don't own any burgers. You own just a piece of the McDonald's company, and so you own their stock on paper. The advantage of this is it is very accessible. If you want to invest in the stock market, whether it's through your 401k or your IRA or your own personal account, it's not that hard to do. All you got to do is open up an account and fund it, and then you can put your money into whatever funds or stocks that you want. Our economy is made up of companies that sell products. This is where you can come in and you can own a piece of some of the biggest companies in our economy by buying some of their stocks on the stock market. If you buy one share of the McDonald's company, you become one of the owners of McDonald's. If you buy one share of Amazon, you become one of the owners of Amazon. You're not going to get to tell Amazon or McDonald's how to run their business, but you get to share in the profits when they make money. If you believe in the future of the economy, that means you think that companies are going to grow and make more money in the future. If companies make more money in the future, that means their stocks, the things that you can buy right now, are going to be more valuable in the future. So you can take your money today and put this into the stock market, into things like paper assets, and now you're buying an asset that if it continues to grow, it will make you more money. This is what financially wealthy people do. They make money, and then before they spend all their money on clothes and cars and things that don't make them any money, they buy assets like stocks, because now their money is going to work and is working to make them more money. Fourth, your money needs to buy you some tangible assets too. I love real estate investing because you get tax benefits and you get passive income, but the difference between real estate investing and stock market investing is when you invest in real estate, you're buying something tangible, something you can see, feel, and touch. When you buy one share of McDonald's, you don't get anything tangible. You're just getting a paper asset. If you invest your money in McDonald's and then their executives run the company into the ground and your stock goes bankrupt, well, you have nothing to show for it because now all your money is gone. If you buy a property, you buy a house, and then your tenant leaves and they destroy the property, you still have a property to show for it. You still own the home. But tangible assets like real estate and gold also have their downfalls. Investing in real estate takes way more work and it takes way more money. I mean, if you want to go and invest in the stock market, you can do that for less than $100. If you want to go out and buy a home, it's going to cost you way more than that. I mean, yeah, you can go out and get a loan from the bank, but you still got to have more money in order to buy properties. And real estate has a way bigger learning curve in order for you to get started. I mean, if you just want to invest in the stock market, you can invest in a fund, an index fund that gives you exposure to the entire stock market, and now you don't have to do any research. You just throw your money in the fund and that's it. If you want to buy real estate, you got to learn to deal with real estate agents and contractors and real estate accountants and real estate attorneys. Plus, with real estate, you are the CEO of your money, and it's your job to make sure your money makes you money. When you invest your money in McDonald's, you got the McDonald's CEO working to make you money. With gold, assuming you're buying physical gold bars, now you have something tangible. I mean, you can see, feel, and touch that gold, but you need a place to store it, which costs money, and that gold is not going to make you any money unless you sell it, and gold isn't producing any more value. When you invest your money in gold, it just sits there and looks back at you. It's not like buying a home where you can rent it out to a tenant who's going to pay you every single month, and it's not like investing your money in McDonald's or Amazon where you have a whole team of people working to make you more money. But you do want to balance out your paper assets by owning tangible assets, because if you see a paper asset crash, like if you see stock market value values come down drastically, you want to have some tangible physical assets that you can fall back on. Fifth, your money needs to buy you some financial insurance. When I say that your money needs to buy you financial insurance, I'm not saying that you just need to go out and buy life insurance, although life insurance is very important. I'll link an article for you in the description below that explains why. What I mean is you need to have some financial protection to protect you and your family against anything. This starts by having a savings cushion. Make sure you have some money in the bank to protect you just in case you lose your job or in case an emergency happens. That way you have money to fall back on. Get yourself a will or some other sort of estate planning because you don't want your family fighting each other over who gets your money when you die. You definitely want to do this sooner rather than later because, well, we can't predict when we're gonna go. There's a couple ways that you can go about doing this. If you don't have a ton of money, then you can just go online and create a will for like $200 or $300. If you have more money or more assets and you wanna make sure that things are done right, then call up an estate planning attorney in your area and have them work with you to create a full plan. That way you know how your assets are gonna be distributed after you die. And financial insurance also means having insurance. Big surprise there, right? Look, I don't like paying for insurance, but it's a small price I pay today to protect me against a big headache in the future. If you have a business, you need business insurance and probably multiple kinds of business insurance depending on how big you are. You need health insurance, car insurance, home insurance, and you might need life insurance too. Again, I have an article below that explains why. Sixth, your money needs to buy you your needs. See what I did there? There's a difference between what you need and what you want. I'm gonna get to your wants in just a second, but you gotta not confuse your wants for your needs. You need a place to stay, but if you don't have any money, do you need to be spending $1,500 a month on rent? When I was in law school, I wanted to invest as much as I could back into me and my business and my investments, so I shared an apartment where I slept on the living room floor. I didn't have a room, and so every night when I came home, I would pull my mattress out, put it into the living room floor, put it on the ground, put on my sheets, go to sleep, wake up the next morning, pack up my sheets, put my mattress back in the hallway, and then go on with my day. That's how I had a place to stay for less than $400 a month, including my internet, including my heat, including my electricity, including my water, and including my parking. You need a car to get to work, but do you need to pay $800 a month for a Benz? No. Before you spend money on what you want, you gotta spend money on what you need and take care of yourself, your physical health, your mental health, your spiritual health, and your financial health by investing your money and building a savings cushion before you go out and buy all the things you want. And this brings me to number 7, spending money on things you want. Anybody can be financially successful if you have discipline and delayed gratification. Delayed gratification means I wanna go on a $10,000 trip to Hawaii, but I don't got $10,000 to do that, so I'm not gonna put this on my credit card and I'm gonna wait to save up more money until I got $10,000 to go on this vacation. The thing you have to understand here with your wants is anytime you spend money on something you want, so a Benz or a trip to Hawaii, that's money that you cannot use to build your wealth. But the whole point of being financially smart is so you can spend your money on things that you want. So it's a balance. You don't want to spend all your money on wants before you can afford it because you're just going to rack up a whole bunch of debt and not have any assets. And you also don't want to have this delayed gratification for your whole life and never be able to enjoy your life. The simplest thing that you can do is create a financial system for your money, like the 75-15-10 rule that we have. What this says is anytime you make $1, 75 cents is the maximum you can spend, 15 cents is the minimum you invest, and 10 cents is the minimum you save. So when you follow this plan, you know what money you have to spend, and now when you have the spending money and you want to buy something you want, follow a rule of 5, which says if you cannot buy 5 of them, you cannot afford 1 of them. Also, when it comes to your wants, don't finance anything that doesn't pay you because now you're paying interest on something that's losing money. 8, use your money to buy your time back. When you have money, you can buy a better car, you can buy a better vacation, you can buy better food, you can buy a better gym membership, but the one thing that your money cannot buy you is more time. Every single one of us get 24 hours a day. That's it. And none of us know when our last day is gonna be, which is why you want to use some of your money to buy your time back. If you work long hours Monday through Friday and all of your evenings are spent cooking dinner and planning for the next day and all of your weekends are spent doing home chores, it doesn't matter how much money you make, you have no time. If you don't like cooking or you don't like doing home chores, then use some of your money to hire somebody to do some of these things for you. That way you can buy your time back. You can save time on weekdays by doing a grocery or a meal delivery service, or maybe even hire a chef depending on how much money you're making. And you can hire somebody to help you with your home chores. That way you don't have to spend all of your time doing that. Now you're effectively buying your time back because now you have more time to do the things that you want to do. We can even put a dollar figure on this. If you value your time at $25 an hour and you can hire somebody to cook for you or clean for you or do your chores for you at $14 an hour, it is profitable for you to hire somebody else to do the things that you don't want to do. That way you have more time. And what are you going to do with this newfound time? Well, you can invest money in 9, doing things you like. You should want to live a fulfilling life, and that means doing things that you like to do. If you have a hobby, spend money on that. Try something new. Try an acting class, try a dance class, try a pottery class. Try new things, see what you like. If you have a spouse or a partner or a family that takes care of you, spend some of your money taking care of them. Again, the key here is to do this when you can afford to do it. These are not things that are going to give you an immediate ROI on your money, but these are things that you can spend your money on because now you have money. And number 10, use some of your money to give back. It costs money to eat and it costs money to feed other people. When you have money, you can take better care of yourself and you can take better care of your community. We've all been in tough situations before, and sometimes we just need a little push. And when you're in a position where you can help somebody, either you have knowledge or you have financial resources, or if you have something else, connections, you can use these things to help other people. The more you have, the more you can do. We all have things that we're passionate about, and when you have money, you can use your money to make a difference. Before we get into the next clip, if you are interested in learning more about how you can manage your money the right way, that way you can build wealth, have a financial system, and invest your money, our team put together an amazing guide that walks you through how to do this. You can download this guide for free when you sign up for our daily newsletter, and you can do that by clicking the link up here or by clicking the link in the description below. The stock market is one of the most accessible wealth building tools that we have, but the issue is most of us are never taught about how to use the stock market the right way. For a lot of people, stock market investing is finding a hot stock, throwing your money into it, and then watching your money disappear. Oh, not again. If you really want to understand the stock market, there's 5 things you need to know. First, you need to understand what is the stock market. In this section, I'm going to be going over what's the Dow Jones, NASDAQ, S&P 500, why does the stock market exist, and how do stocks work. After that, we're going to be talking about how you can make money. So this is the difference between making money through dividends and appreciation, what causes a stock to go up. Then we're going to talk about different investing strategies. You might have heard people talk about fundamental analysis, technical analysis. I'll be talking about active investing and passive investing in this section. Then I'm going to be talking about some of the different investment options you have. You might have heard people talk about things like growth stocks, blue chip stocks, REITs. We're also going to be talking about mutual funds, index funds, and ETFs. And then we're going to wrap it up by talking about how do you actually research the stocks and take action. So this is looking at things like 10Ks, 10Qs, researching stock charts. This is where you actually are making the money because now you're taking action. I'm going to be going over these 5 things in this video, but before I do that, I need you to do me a quick favor and smash that thumbs up button below, because the way the YouTube algorithm works, if you do not smash that thumbs up button, then YouTube is much less likely to show you and other people our financial news and education videos. Let's start with this. What in the world is the stock market? The stock market is a place where you and I, regular people, can go and invest in companies. When you invest in a company, you become one of the owners of a company. So if you go out and you buy one of the shares of the McDonald's stock, you become one of the owners of McDonald's. Now, if you just buy one stock, you're not a major shareholder. I mean, you only own 1/750 millionth of the company, but you're still one of the owners of McDonald's. And as an owner, you actually get the right to vote on some of McDonald's business decisions. A company that trades on the stock market is known as a public company because this company is publicly traded, meaning anybody can go and buy shares of this company on the stock market. You can compare that to a private company, kind of like ours, Minority Mindset, because you can't buy shares of Minority Mindset on the stock market. If you wanted to buy an ownership stake in Minority Mindset, you would have to call me up and I would say, sorry, we're not selling. The reason the stock market exists is it's a way for companies to finance the future growth. So if you are a big company and you need more cash to grow, then what you can do is you could sell 20% of your company now instead of to private investors to the public market on the stock market by now giving this 20% of ownership to the public on the stock market. Now you are a publicly traded company and everybody knows how much your company is worth, and people have the opportunity to buy shares in your company. When you hear people say things like the stock market is up or the stock market is down, what they usually mean is an index like the Dow Jones or the S&P 500 or the NASDAQ is up or down. So these are called indexes because they're essentially baskets or groups of stocks. The Dow Jones is a group of 30 very big companies. The S&P 500 is a group of 500 of the largest companies on the stock market, and the NASDAQ is a group of tech companies. So they're called indexes because they're groups of stocks, and they essentially just give you a sample of what's going on in the broader stock market. When you invest in the stock market, you can invest into individual companies like McDonald's, I mentioned that just a minute ago, or you can invest in an index and get exposure to the broader stock market, but I'll be talking about that in just a little bit. Second, how do you make money in the stock market? Well, in general, the goal in the stock market is to invest in a company that becomes more profitable and makes more money. That way you make money, but the way you make money is one of two ways. When you invest in the stock market, you can make money through appreciation or dividends. Appreciation is when you invest in a company and the value of a company goes up. So if you invest in a stock and you buy the stock at $100 a share, and 2 years later the stock goes to $200 a share and you sell it, the $100 of profit that you just made is called appreciation. Other times you can also make money through dividends. Dividends are literally just cash payments that a company gives you because you invested in a company. So if you go out and invest in a company that's trading for $100 a share, sometimes this company is going to send you a $5 check every single year just because you own shares of this company. You can think of it this way. When a company is mature and they have a lot of cash and a lot of profits, there's three things that they can do with their extra cash. They can save this cash for an emergency, they can invest this money back into their business, that way they can grow bigger, or they can reward you, the shareholders, the investors, by giving you some cash. That way now you're happy for investing in this company, and this will attract more investors to want to invest in this company. Most dividends are paid quarterly, meaning every 3 months. So if you invest in a company that pays a dividend, you're gonna get a check every 3 months, or if you want, you can have this cash reinvested into your stock. That way now instead of getting a physical check, you are getting more stock in the company. Now, dividends sound cool. I'm a big fan of dividends, but there are a couple drawbacks with dividends that I want you to understand. First, when a company pays a dividend, you have to understand that means the company is not necessarily going to grow as fast, because if a company is paying out $1 billion in dividends, then that's $1 billion the company is not using to actually grow the company to make more profits and make more revenue. So if you have a company that's paying out a lot of dividends, you're typically not going to see as much appreciation as you would if a company was using this money that's spent on dividends to actually grow the company. So if a company is paying out dividends, they're usually more stable companies and they're bigger companies because they have a lot of cash that they don't really want to invest back into the company, so they're rewarding their owners with the dividends. Second, with dividends, you have to pay taxes on your profits. So this is kind of like your pro and con. You have to pay taxes on all of your income, but with dividends, if you are reinvesting your dividends back into the company, you're not getting this cash in your hand, but you still have to pay taxes on the profits that you got. Not every company pays a dividend. So if this is something you're interested in, you have to look into the actual company and see if they're paying a dividend or not. And like I was saying before, the companies that pay dividends are typically your larger, kind of more mature and established companies, because your smaller companies, your growth companies, the tech companies, the ones that are really trying to grow fast, they're investing every dollar they can back into the company because their goal is to grow as big as possible, as fast as possible. So companies like that, their goal is to grow their stock price as fast as they can. The advantage with that, if you're investing in a company that's investing heavily in their growth, is you don't have to pay taxes on dividends because you're not getting any dividends. A company is investing their money back into the company, so hopefully you have a big stock price and you don't have to pay any taxes on your appreciation until you actually sell your stock. So that's one of the advantages of appreciation. But one of the downfalls is it also comes with more risk, because there's a chance that the company will fail, and if the company fails, you don't have anything to show for it because you didn't get any cash through dividends. So they both have the pros and cons, and as an investor, you need to know why you're investing. Are you investing for this or this? The question now you might be wondering is, what causes a stock price to go up? Well, on a very broad level and a very simple level, stock prices go up based on supply and demand. If you have a lot of demand to buy a stock and there's not a huge supply of stock, then the price of the stock is going to go up because you're going to have buyers that are fighting each other to buy the stock, and this is going to push the stock price up. And if you have a lot of supply but no demand because nobody wants to buy the stock, then you're going to see the price of the stock fall. In the short term, the supply and demand is really fueled by emotion. Like, people might think, oh my God, Tesla is the future, and everybody gets behind Tesla, and then you see this huge demand to buy Tesla, so the price of Tesla stock goes up. But in the long run, what really affects the stock's price is its fundamentals. That's how much money is the company making, how are their profits looking, are their revenues growing, are their profits growing, how is the management, and are they innovating for the future? So these are the things that really affect a company's stock price over the long term. But in the short term, a company's company's stock price can be really volatile based off of people's emotions because the stock market is emotional. If you want to invest in stocks, it is very simple. All you have to do is open up a free account with a stock brokerage, and then you can buy or sell whatever stocks you want. Back in the day, it wasn't so easy. Back in the day, if you wanted to invest in the stock market, you'd have to call up a stockbroker, and then the stockbroker would then have to make a deal with Wall Street and then buy or sell whatever stock you want. It was a very long and difficult process, but now it is very simple. If you do want to learn more about how you can find a good stock brokerage to use based off of your financial goals, our team has articles on this on our website, theminoritymindset.com, and I'll also link an article for you up here and in the description below. Third, let's talk about investing strategies, because there's more than one way to invest in the stock market. And this is one of the biggest mistakes that people make when they invest in the stock market, because for a lot of people, their strategy is invest in a company that I think is going to be big, and then when it goes down, sell it for a loss. There's a lot of ways to invest in the stock market, and you need to have a strategy on how you're going to make money. If you want to be a stock market investor, then when you buy an investment, your goal should be to own your investment for at least a year. Because if you don't own your investment for at least a year, then you're also going to be subject to higher taxes, because the way that the tax code works, if you own your investment for longer than a year, then that's categorized as long-term capital gains and you get lower tax rates. But if you buy a stock and sell it for a profit in less than a year, then you're going to be subject to higher taxes called your ordinary income taxes, because the United States government and the IRS doesn't look at that as an investment, because now you're just trading, you're flipping stocks. This isn't to say that you cannot make money trading stocks. This is for you to understand what your goal is as an investor, because if you don't know what your goal is as an investor, you're not going to be able to come up with a strategy. On the very highest level, there are two different kinds of investment strategies. There is an active way of investing in the stock market and a passive way. An active investment strategy means that you're now actively researching companies and stocks and you're buying based off of that. And passive means you're not really doing much research. You just have some money automatically being invested for you every week or every month. Now, within this type of active investing, there's a whole bunch of different strategies that you can use, but they ultimately come down to doing two different types of research. You can either do fundamental research, so I'm gonna call it fund, or technical research. Or you can also do both depending on what strategy you have, but those are the two types of research you can do, fundamental or technical. As a passive investor, you're mainly going to be looking at the fundamental type of research. Fundamental research means you're looking at the company itself. You're looking at how much money a company is making, what their profits are, who the management is, and how they're innovating. Technical research means you're looking at stock charts. You're looking at momentum. You're saying, oh, this company looks like it's about to go up because of all these indicators, and so you buy based off of that. Warren Buffett is a fundamental investor. He likes to look at companies, he likes to read financial statements, and he wants to find a company that's undervalued, and he wants to own it for a long time. That way he can make a profit over the long term. And he is an active investor because he does the research to actually find the companies to invest in, and he is the one that's picking these stocks and doing this research, and he makes these decisions when he thinks it's a good time to invest. You can compare that to a passive fundamental investment, where now you can pick a few stocks or a few funds that you want to own, and then every single month you have $100 or $1,000 or $10,000, whatever you can afford. You have this money going into your investments, being divided up into your 3 or 5 funds, whatever you have, and this is just passively happening without you actively trying to find new funds. It's just every month or every week, more money is just being invested into your account. Technical trading is now when you're looking at stock charts and you're looking at momentum. You're looking at different indicators that tell you that you think the stock price is going to go up. Maybe you're looking at how many people are buying the stocks of the volume. Maybe you're looking at moving averages to kind of see the trend of which way the stock price is moving. So you're looking at different indicators to tell you that you think the stock market is going up, at least in the short term. If you don't like the idea of putting time into the stock market, or if you don't care about studying companies, or if you don't care about stock charts, then passive investing is probably best for you, because this one requires the least amount of work. You find a few stocks or funds that you want to invest in, and then every week or every month, you are just going to continue to put money into that. If you like the idea of looking at companies, but you don't like the idea of looking at stock charts or looking at these moving averages, you just want to invest in a company like Warren Buffett does because you want to find an undervalued company and invest in it for the long term, then being an active fundamental investor is probably best for you. If you don't like the idea of waiting years to potentially see a profit, then technical investing is probably better for you. Now, while technical investing can make you the most money in the short term, it also comes with the most risk, because your goal is to make money in a shorter amount of time. A lot of technical investors are buying and selling stocks within a year. Fundamental investors are usually looking to make money over the long term. So now we're talking multiple years, and so there's less risk, but also less opportunity to make a whole bunch of money very quickly. For the vast majority of people who don't care about studying companies or reading financial statements or spending time learning the stock market, passive investing is the right way to go. Now, I already made a video where I went over passive investing in good detail, so if you want to watch that video, I will link it for you in the description below. Fourth, let's talk about the different types of investments on the stock market, because one way you can invest in the stock market is by investing in stocks. But that's not the only way that you can invest in the stock market. You can invest in the stock market and make money in the stock market by investing in individual stocks. You can invest in mutual funds, you can invest in index funds, and you can invest in ETFs. If you are subscribed to our YouTube channel, you've probably heard me talk about these things before, and if you're not subscribed to our YouTube channel, you should probably do that. Stocks are when you're investing in individual companies. This is what I've been talking about most of this video. So if you invest in the McDonald's company, or in Lululemon, or in Tesla, or in Amazon, or in Apple, now you're investing in individual companies. And within the stock segment, there are different types of stocks out there. Like, you can invest in blue chip companies. These are your more stable, more established, your larger companies. You can invest in growth companies. Growth companies are your startups, your smaller companies. These are companies that are investing heavily into their growth. So growth companies are not companies that are paying out dividends. These are companies that are spending every dollar they have back into their company to grow as big as possible, as fast as possible. So more risk, but the opportunity to see more appreciation. You have things like REIT stocks. REIT stocks stand for Real Estate Investment Trusts. These are companies that pay out high dividends because these companies make money through rent, and the law says that REIT stocks are required to pay you 90% of their taxable income through dividends. So REITs give people exposure to real estate, and you can make income through dividends without having to go out and physically buy real estate. So these are a few ways that you can invest in stocks. And again, you want to invest in stocks based off of your investment strategy, your investment goals. But this isn't the only way to invest in the stock market, because the downfall with investing in stocks is if you invest your money in a stock, let's say Amazon, and Amazon starts to fail, they start losing money and they go out of business, then all of your money goes down the drain. Now you might be thinking, oh, Amazon's never gonna fail. But you know, companies do fail, and if you invest in a company that fails, then all of your money is gone. That's where these options come in handy. Mutual funds are indexes, so a group of stocks that are managed by a very experienced and usually a very expensive money manager. So when you invest in a mutual fund, you are paying this money manager to find you a portfolio and investment in stocks, and this person is going to manage your stock portfolio, and their goal is to help you beat the market, and in exchange, you're going to pay them a fee. Index funds work very similar to mutual funds, except with index funds, you're not paying a money manager to manage your account. This is passively managed by a computer. So essentially with an index fund, you can invest into an index, like you can invest into an index that gives you exposure to the top 500 companies on the stock market. And now, if these top 500 companies go up, your index fund goes up. If these top 500 companies go down, your index goes down. The advantage with index funds is you tend to have low fees, you tend to have less risk, and you can typically match the returns of the stock market. The downfall is you typically have less potential upside because you might have some great companies in your fund, but they're going to be balanced out by the losers. But this can be a good way for you to invest and get low fees and get exposure to the general stock market. An ETF is an exchange traded fund, and this is kind of like a basket statement, because all this means is this is a fund that you can buy and sell on a digital stock brokerage. So the reason the word ETF even exists is because a lot of mutual funds cannot be bought and sold on the stock market. If you want to buy a lot of mutual funds, you have to call up a broker and purchase shares of a mutual fund manually. With an ETF, it's all electronic, so you can buy and sell shares of this ETF kind of like you would any other stock. Now look, I am just a random guy on YouTube, okay? So you should always do your own due diligence and never blindly listen to a random guy on YouTube, because investing has risks and you are never guaranteed to make money when you invest. But a couple examples of index funds that give you exposure to the general stock market are VOO and SPY. If you invest in one of these two funds, you will get exposure to the top 500 companies in the stock market, and now you don't have to go out and try to find the best stock to invest in. Now you're investing in the general stock market. I want to kind of give you an idea of what long-term returns in the stock market look like when you play the stock market for the long game. So over the long term, the stock market typically goes up by somewhere between 7 and 10% a year. Now, this doesn't mean the stock market always goes up, and this doesn't mean that it always goes up by 7 to 10% a year. This means on average, it goes up by 7 to 10% a year. Some years it'll be more, some years it'll be less. Sticking with the lower end of the equation, let's say you invest $10 a day or $300 a month, and and you can get a 7% return on your money. And let's say you do this for 45 years. So you start doing this when you are 21 years old and you continue to do this until you retire at 66. If you do this and every single month you invest $300, you will retire with $1.1 million from your $10 a day investment. The reason I want to show you this because let's say you start a little bit later. Let's say you start investing not at 21, but now at 31, and you continue to do this until you're 66. So now this is 35 years, but you're still doing the same investment. You're still doing $10 a day or $300 a month. Now, if you do the same investment, you're not going to retire with $1.1 million. You're going to retire with $535,000. Still a lot of money, but you're leaving a lot of money on the table because your money doesn't have as much time to compound. Time is very important when it comes to investing your money over the long term because every single year your money has more time to grow and compound, and the longer you let your money grow, the more wealth it's going to build you. If you want to grow your money even more, then there's two things you can do. You can either invest more money or invest your money more aggressively, meaning get a better rate of return. So let's assume now that you're investing $20 a day and you continue to get the 7% return a year. If you do this for 45 years, so you start when you're 21 and you continue to do this until you're 66, then you are going to retire with over $2.2 million from your $600 a month investment. If you cut 10 years out of the equation because you didn't know about investing until you're 31, so you do this for 35 years, now you will only retire with $1 million. Now, I know, only $1 million. $1 million is still a lot of money, but you're leaving a lot of money on the table by not starting sooner. This is where a lot of people say things like, oh, I didn't start investing when I was younger. Did I miss my shot at becoming wealthy? Is it too late for me to start investing? No, it's not. Remember what I said before. If you want to get better returns, you either have to invest more money or invest more aggressively. Maybe you have to invest more money, or maybe you have to be a little bit more active with your investments. That way you can get a better return. So now let's go through this example again, where you're investing $20 a day and now you're a little bit more aggressive. So you're trying to get a 10% return. If you do this for 45 years, just to show you the example, now you're going to end up with $5.5 million. If you start a little bit later at 31 years old and you do this for 35 years, now you're going to end up with $2.2 million. So you're still a millionaire. And if you start this at 41 years old, now you only do this for 25 years, you're still going to end up with $750,000 in retirement. So time and consistency are very important for you to build this wealth over the long term. And if you're trying to make up for this lost time, then you need to either invest more aggressively or invest more money. And if you don't have extra money to invest, then you might have to look into doing something like a side hustle or starting your own business. That way you have extra cash to invest. That way you can build your wealth. And this is also more of a passive investing structure. Right now, you're not trying to get amazing returns. You're just trying to match the market by passively investing your money into a fund that gives you the same returns as the stock market. Active returns can get you better returns, but again, it comes with more risk. Like if you had invested $10,000 in Amazon back in 2010, that $10,000 investment would have grown to $170,000 in 2020, but that again comes with more risk because there's a lot of companies that didn't get the same returns as Amazon. Now, when it comes to research and taking action on your investments, you have to understand that the investors that make the most money are not the investors that invest on emotion. It's the investors that invest on financials. A lot of people are investing in the stock market when they feel excited because they think, oh my God, so many people are making money in this stock, so let me buy in. And then when the stock starts to come down, they panic and they sell. If I had to diagram it out for you, it looks something like this. So you see a stock go up like this, then somebody at this point gets excited, they get greedy and they say, oh, everybody's making so much money because the stock has shot up so much. So now they come in and buy at the peak. And then people realize that, oh, this stock might be a little overvalued. So they start taking off their profits right here. And what do you see happen? The stock price starts to come down. And now when the stock starts to come down, people start to panic sell. And now this is where you sell because you panic, you get worried, you see your stock in the red, and so people sell. I do not want you to be an emotional investor. I want you to be a financial investor, which means you need to know how to do the research. That way you can find the information you need to actually invest in a company for the long term to make money. When a company is publicly traded, so it's on the stock market, it is required by the SEC to release certain information about the company. That way people like you, investors, can make smart decisions. One of the things that a company is required to do is every 3 months or every quarter, it is required to have an earnings call where it releases something called a 10Q. A 10Q is its quarterly, so every 3 months, a quarterly financial statement. This statement will tell you how much money a company made, how much revenue it made, how much profit it made, how much money it lost. This is how much money it made over the last quarter that it's reporting for. But what you need to remember about the 10Q is these are unaudited statements. So these are statements just released by the company. A 10K is an annual statement released by a company. So every single year, a company is going to have to compile all of their financial data for the last year, how much money they made, how much money they lost, where their money is going, and all of that information, and they're going to compile it into the 10K. The interesting thing about the 10K is this is supposed to be a little bit more accurate because these are financially audited statements. You want to be reading the information that's on these documents. Now, if you don't want to actually read these actual financial statements, what you can do is go to a stock website like Seeking Alpha or finance.yahoo.com. I'll link these for you in the description. You can go to these websites and they're going to break down the information that's in these financial statements. So you can go there and see how much revenue a company is making, how their revenues have been growing, how the profits have been doing, and everything else, and they will list it out for you. That way you can look at the financials of a company. When it comes to doing technical analysis, that's when you're going to want to be looking at stock charts. So you can go to a website like stockcharts.com, and then you can look at different indicators for a stock. There are tons and tons and tons of different indicators out there, and so what you want to do is create a strategy that you follow, because one indicator might tell you to sell and another indicator might tell you to buy. So you need to make sure that you have your own strategy and look at the indicators for that and follow your investment goals based off of your strategy, because if you don't, then you're going to go down this rabbit hole of never knowing what to buy and when to sell, and it is going to be very overwhelming. Real estate is my favorite place to invest my money because when I invest in real estate, I can predict how much money this property is going to make me every single month after I buy this property. And so when I'm buying real estate, my goal is just to build up a number of properties that way each property is paying me every single month. If you can make $500 a month in profit from one property, which is doable, then if you have 10 properties, that's $5,000 a month coming into your pocket in profit that you don't have to work to earn. That's $5,000 extra every single month that you can use to spend on whatever you want. I've been investing in real estate for about a decade now, and I've seen real estate from a few different lenses because I'm a real estate investor, I'm an attorney, and I used to be a real estate salesperson. And in this video, I'm going to be going over the 10 things you need to understand when it comes to buying your first rental property. But before we get into that, I need you to do me a quick favor and smash that thumbs up button below. The 10 things that you need to understand when it comes to buying your first or your 10th or your 100th rental property is first, the location, because you probably heard when it comes to real estate, location, location. You cannot move where your property is, so your location matters. Second is understanding the cash flow, the finances. How do you understand if a property is profitable or not? What numbers do you got to look at? Third comes to actually negotiating the contract. How do you find a good price? How do you make it work? How do you negotiate that? 4 is inspections. What kind of inspections do you need? How do you make sure a property is good and that it's not going to screw you over after you buy it? 5th is financing. How do you actually get the cash to buy the property? 6 is the legal side, because the last thing you want is for your tenant to sue you because they slipped and fell in your bathtub because it was too slippery when it was wet. True story. 7 is renovating the property. How do you renovate it and how do you get the best return on your money? 8 is actually finding a tenant and renting it out. 9th is making the property passive. That way you don't have to physically work to get this cash flow. And number 10 is if you are ready to sell the property, how do you sell the property and not pay any taxes legally? Let's get into number 1, starting with the location. When you're looking for a property, before you go out and you actually make an offer and buy a rental property, the first thing you want to do is look at a bunch of different properties. You got to look at least 10 properties before you make an offer on one, because if you're just starting off, you're not going to know what a good location is or what a good property is or what a bad one is. And so you want to just start walking through homes and start walking through neighborhoods. One of the easiest things that you can do to determine if a property is in a good location or a bad location is just walk the neighborhood, walk through the streets. Is there something nice? Are the homes boarded up? Are they burned down? Or is it nice? Are your neighbors taking care of the landscaping? Is there money coming into the area, or is the money in businesses moving out? There are 3 big things that you want to look at when it comes to finding a good neighborhood or a good city to invest your money in. crime, the flow of money, and the city laws. There are a bunch of tools on the internet that you can look at to see what the crime is in the neighborhood that you're looking to buy in. If you see that the crime is increasing, that's not a good sign, because when you buy a property, this is something you're owning for the long term, right? When you're investing in real estate, this isn't a 6-month play or a 1-year play. You're investing in real estate for a long time because you're going to own this property and you want this to pay you rent for years into the future. And if you're buying a property in an area on the verge of a downturn, then your investment is going to be more of a headache than it is a cash cow. When you're looking at the flow of money, what you want to pay attention to is, are businesses coming into this area, this neighborhood, and the city where you're investing, or is money flowing out? The easiest way you can determine this is just by going to your city hall and asking them what new developments are coming in and what new building plans do they have for that area. If they don't have much, or if you see that this building development is going kind of somewhere away from where your property is, that's not a good sign. This one is huge. I was in contract to buy a home and I went to the city and they told me that there was this vacant plot of land that was nearby the home that I was buying, and Walmart was coming in and they had plans to develop a Walmart supercenter. That was good news for me because that told me that money was flowing here. If Walmart was willing to open up a store less than a mile from my property, that means there's going to be more jobs coming. That means there's going to be more retail stores coming, because anytime you see a Walmart supercenter pop up, that means you're going to have more stores pop up in front of it and on the side of it, because Walmart drives a lot of traffic. So if there's a lot of money coming in that area, that means property values are probably going to go up. Rental values are probably going to go up because there's going to be more demand for that area, because there's more jobs and more businesses coming. So is the money flowing to the area or out? Because if the money's flowing in, then you can buy this property today and you can expect rent prices to hopefully continue to go up, because now there's more money and jobs coming into that area. And then you want to take a look at the individual city laws itself, because what you're going to see happen is some cities are more tenant friendly and some cities are more landlord friendly. A tenant friendly city is going to make it very hard for you as a real estate investor or a landlord to kick out a tenant that's not taking care of a property or that's not paying you rent. And so you want to pay attention to that, because if you are investing your money, you want to be in a city that is more landlord friendly, ideally, because if somebody is not paying you rent, you want to have the ability to kick them out without facing a whole bunch of roadblocks and a bunch of hurdles. Another thing you want to pay attention to when it comes to city laws is how strict is the city when it comes to city inspections. Now, there are certain cities that I just avoid buying in because they have these super strict standards, and they will fine you up the you know what if you have grass that grows 2 inches, or they're going to charge you a $200 permit fee if you got to change the batteries in your smoke detectors. I've already dealt with the headache and I don't want to deal with that anymore. So when I invest in properties, I'm looking at what the city laws are, and the best way you can figure this out is just by talking to real estate investors or real estate agents in your area that are familiar with investment properties. And so if you're looking at properties, talk to a real estate agent, because they can help you find some. And if they're actually familiar with real estate investing, they should understand how these city laws work, so they can guide you and help you find areas where you won't have to deal with all the headaches. When you're investing in real estate, you have to be thinking for the next 10 years, because you cannot move the property's location. I mean, if a home is beautiful, that's nice, but if it's in a really bad location, the niceness of the home doesn't make up for the bad location. One of my real estate teachers used to tell me, find the worst home in the best neighborhood, because the neighborhood is going to help drive up the home value and the demand for the property. If it's a good home in a bad area, it doesn't matter. You're going to have a really hard time making a profit on it. But if you have a bad home in a good area, now you can be sitting on a gold mine, because you can renovate the property and you'll still have demand for people wanting to live in this home because it's in a good location. Sometimes that means you'd be better off paying a little bit more for a home on one side of a street than another side of a street. Like, I was looking at buying a home in a city where they had a highway cutting right through the middle of the city. But on one side of the city, these homes were about 20% more than on this side of the city. But what I saw by talking to the city hall was that there was a lot of new developments coming on this side of the highway, and there was a lot of businesses moving out of this side of the highway. So it's the same city, and we're talking about just on one side of the road. But I decided to buy here, even though this cost me 20% more, because I saw that there was money flowing in this area. Over the next 5 years, rental prices here went from about $850 a month to $1,200 to $1,300 a month, while rental prices here dropped just because everybody wanted to be on this side of the road, not this side of the road. So you got to understand why your location is so important, because it's going to play a factor into how much money you make over the long term. Once you narrow down what cities and neighborhoods you want to invest in, and you start looking at properties, that's when you got to understand, when do the numbers make sense? How do you analyze the finances of a property? I'm going to get to actually how you get the cash a little bit later in this video, but let's talk about understanding the numbers first. I like to be conservative when I do my financials, because I have no problem if I run run my numbers and then I make more money than I thought I was gonna make, but I'll be a little bit more disappointed if I make less money than I thought I was gonna make. So I like to do my numbers accordingly. So the way I look at it is, first I take my rental income, whatever money I think I'm gonna make, and if you're working with a real estate agent, they can help you figure out what your projected rent will be. And then you want to subtract your property taxes, your insurance, your maintenance, because you're gonna have maintenance if you own a property, then your management costs because you want this to be passive, and then your vacancy because your property is probably not gonna be leased out every single month. You subtract these from this, and then you're gonna have your net income. So let's run through an example. If you wanted to buy this property that was $150,000, what would the numbers look like? So if I bought this property for $150,000, I should be able to rent it out for something like $1,400. Maybe a little bit less, maybe a little bit more depending on where you live, but let's assume $1,400. So taxes, property taxes, I like to estimate around 2% of the property price. So if we're looking at $150,000, that's $3,000 of property taxes a year, and that is right around $250 a month for property taxes. Then insurance, or a $150,000 property, something around $100 a month in your property insurance, landlord insurance. Then for maintenance, I like to be conservative and I like to estimate 10% of my gross rental income. Hopefully my maintenance is gonna be way less than that, especially if I buy a property and I renovate it. After I get the property renovated, hopefully my maintenance is gonna be close to nothing, but I wanna be conservative. So if I do 10% of that, that's $140 a month in maintenance. Management fees, I like to estimate 10% for management fees. Now I pay way less than that because I have a number of properties, and so I worked out a deal with my management company. I'm paying close to 5% in management fees, but if you're just starting off, you might be paying that 7 to 10% range. So if you want to be conservative, that's another $140 in management fees. And then vacancy, I like to estimate 1 month of rent a year in vacancy because your property might not be tenanted all 12 months of the year. Somebody might move out, and so you're gonna have a period of time where you're gonna be leasing the property out and not making any money. So if I'm not making 1 month of rent out of the year, that means that's another $116 or so that I'm not getting. So if I add these all up, I got my calculator right here, that leaves me with a net income of $654. Let me get my black marker. So $654 a month is what I'm making off of this property. Now this is assuming you bought this property with cash. I'm gonna go over what happens if you bought this property with a loan in just a second, but you're making $654 a month, which is $7,848 a year, and you paid $150,000 cash to buy this home, which means you are getting right around a 5% cash on cash return a year. Now personally, this is a little bit lower than what I'm looking for, but this gives you an idea of how to run the numbers. When I look at a property, I'm looking for a minimum 7% return on my money, assuming I buy the property cash. Ideally 8%, but a minimum 7%. So maybe I'll have to get a better rent. Maybe I'll have to pay less money in management fees, which I'm already doing. Maybe I'll have to see if I can get a better deal on my insurance. Essentially, I gotta have more money every single month in order to make this deal worthwhile. But what happens if you bought this property with a loan? If you use debt, then you might be putting down 20% of the home value, $150,000. So you have to put down $30,000 cash, and then the bank is going to give you $120,000. So now you have the $654 a month that you have in profit, but you also got to pay your bank. And if you are borrowing $120,000, you might be paying your bank something like $560 a month, which leaves you with just under $100 a month every single month in profit. I think it's about $94 a month in profit, and this will bring your total return down on your $30,000 cash investment to right around 4%. So not the best return, but again, we're being pretty conservative here. You should be able to get a little bit better rent here. You shouldn't be paying this much in maintenance. So you can probably bump these numbers up in reality a couple percent, but I'm just trying to show you how the numbers work. So anytime you walk through a deal, these are the numbers you want to be looking at, and you want to make sure you do this analysis for yourself, because sometimes you're going to see sellers agents create their own pro formas to show you that you're getting this amazing return on this property that you're looking at, but they might not include vacancy, they might not include management, and they might really lowball this maintenance cost. And so all they're really showing you is your rent minus your property taxes minus your insurance, and they're ignoring this half. And so you want to make sure you're doing this pro forma yourself, that we can get kind of a real idea of what the numbers will look like in your bank account, not just what they look like on an Excel sheet. The last thing I want to mention about the finances is this return that I'm showing you is just the return you're getting every single year on the cash that you have to invest today. This did not include property appreciation, home prices going up or real estate prices going up. That's just the icing on the cake. When you buy real estate, you want to make sure that this number makes sense for you. If this number makes sense for you and then real estate prices go up, that's even better. If real estate prices come down, oh well, at least you're still making your rental profits here. But the reason why your location matters so much is because now what you're going to see happen over the years is this top line rental number is going to go up, while at the same time your expenses aren't going to change too much. Yeah, they'll go up a little bit, but they're not going to go up as fast as the rent as long as you're in a good location. So what you're going to see happen over the years is the return that you're getting on your cash is going to increase every single year that you own the property, because you're going to see rental prices go up with expenses not growing as fast, which is why you want to own a property in a good location. And then when it comes time to sell, the advantage here is, let's say the property value doubles to $300,000. In this instance, you put down $150,000 and you doubled your money, because now you're getting $300,000 when it comes time to sell. Here, you only put in $30,000 and then you're going to make another $150,000 in profit on the sale price, because you only put down $30,000 and then you make another $150,000 on the appreciation of the property. Now, when you find a property like where the numbers make sense, now it's time for you to negotiate the contract, because you want to make sure you get the best deal possible. And the type of negotiating and the leverage that you're going to have is going to depend on what type of market that you're in. If you're in a seller's market where property values keep going up and everybody's trying to buy a property, then you're not going to have as much negotiating room as you would as if you were in a buyer's market when everybody's trying to sell their home and home prices are going down. During these markets, you can be super aggressive with your offers and still probably buy the home just because that's the market that you're in. Things that I do to find the best deals is, one, when I look at properties, I'm not looking at the super nice homes. I'm looking at kind of those medium range homes, not the super bad homes and not the super great ones, right in the middle range, because I found those to give me the best returns. And second, when I try to find properties, I like to find properties that are beat up, either beat up physically or beat up financially. In the real estate world, they're called distressed properties. I like to call them value add opportunities. Essentially, I like to find a property, if it's physically beat up, that is cosmetically challenged. So it might have really bad floors, the paint might be ugly, the kitchen might be outdated, the landscaping might be horrible. When a regular person walks through this home, they're gonna be like, oh my God, this looks ugly and it smells, I don't wanna look at this, and so they're gonna walk out. For me, that's a great opportunity, because now I'm not really competing against anybody to buy this home, so I can buy this property way below market value, and I can renovate the property and make it look brand new, and then own this property at a huge discount below fair market value. If you're looking at commercial properties or multifamily apartment complexes, you can also find a financially distressed property, which means you might have a 20-unit apartment complex, and this apartment owner, this real estate investor, doesn't know how to manage the property, and this 20-unit apartment complex has nobody paying their rent, and it has a lot of vacancies. And so this is financially distressed because this apartment owner, this real estate investor, is losing a lot of money, and so they just want to get the property off of their books, so they're willing to sell it at whatever price because they just want to get rid of it. If you are an experienced investor and you have the right team, then you can come in and buy this property and turn it around and make a much bigger profit, because now you're buying this property for way below market value. The key for any of this to work is you got to put your emotions on the side and you got to focus on the numbers. So many people get caught up on the emotions because they want to invest in a cute home. But when you invest in a cute home, you're going to have cute profits. If you really want to make the money, you got to invest on the numbers, right? So if you're looking at a property and it's ugly, it might not look nice, but you can turn this property around and make a lot of money on it if you look at the numbers. When I was first looking at properties back during the 2008 crash, I took my mom with me a few times, and these properties were ugly. I mean, they were beaten up, they had mold and mildew inside, but they were selling for dirt cheap. And I remember my mom telling me, oh my God, I don't want to be in here because these homes are so nasty. I mean, there was holes in the walls, there were sometimes animals living inside. So a lot of these homes are super beaten up, because this was in Michigan, which was really hit hard by the 2008 crash. And a lot of these homes were selling for $5,000, $6,000, $7,000. And now today, these homes are worth almost $100,000, rented out for $1,000 a month. But I didn't buy some of these just because I got emotional and I didn't realize realized that I could have turned these kind of like crap properties into gold mines if I just understood to let my emotions be on the side and understand the numbers. This is where you got to understand that real estate investing is not for everyone. I mean, you got to get down and dirty and you got to work with a bunch of people. You got to find the real estate attorneys, the real estate agents, the real estate contractors, and the property managers. And so you got to find these people, work with them, and really understand how the process works. If you're not interested in that, then it's going to be hard to really be a successful real estate investor. I mean, yeah, you could just throw in money and find somebody to go find you the deals and do all that, but you're going to get a lower return because you're not willing to go out and actually find the deals and maybe renovate them. You don't have to do single family homes. You can do much larger apartment complexes and you can do more commercial properties, but if you're not willing to go out there and put in the work, you're going to have to pay the price for that in lower returns. Now, there are alternatives with things like real estate crowdfunding, where now you can just invest your money and get exposure to a real estate fund. That way you don't have to deal with tenants or property managers or any of that. So if you want to learn more about that, our team put together an article that breaks down how you can invest in real estate without actually buying physical real estate. If you want to read the article, it's on our website, theminoritymindset.com, and I'll link it for you in the description below. But when it comes time to negotiating the contract, one thing that no matter what you are doing when it comes to price, one thing that you have to incorporate is a property inspection contingency, which says that you have the ability after you enter into a contract to go through the property with your own private inspector or your city inspector, and then you can decide if you want to continue buying this property or not. It is so important, and let's talk about it in number 4. Not doing your proper due diligence and getting the right property inspections is one of the easiest ways to make a deal go bust. I'm telling you this from experience. There was one deal that I did. It wasn't even a big deal. It was a small home that I bought because a contractor that I was working with told me that this would be a great investment. I purchased the property based off of his word without doing any of my own private property inspections, and that single deal came around to bite me in the butt, and it was one of the biggest headaches I had ever had to deal with in real estate. I made a video where I talked about this in my worst real estate deal ever. If you want to watch the video on YouTube, I'll link it for you in the description below. But essentially, if you have a property inspection, you can take a private contractor, a private inspector, and this person's job is literally to just walk through the entire property and make sure your property is not on the verge of falling apart. So they're going to walk through and see the foundation of the property. They're going to see how the roof is. They're going to see the mechanical, the electrical, your plumbing. So they're going to go through the entire property and make sure the systems in the property are working, because the last thing you want to do is buy a property and then find out you need $100,000 worth of renovations when you only budgeted $6,000 worth. Getting a private property inspection is going to cost you a few $100s. And this is money you have to pay before you actually buy the home, because as soon as you enter the contract, you want to have the contingency period, this due diligence period, where you can inspect the property with your inspector. And so you're going to pay this inspector a few $100s, and they're going to go through the property and they're going to give you a report which tells you everything that's wrong with the property physically. And once you get that report, you can decide if you want to continue buying this property, or if there's a lot of repairs and renovations that need to be done. You can tell the seller, hey, I need a discount on the price, because right now they're kind of like on the hook, because if you don't buy it, then the seller has to start the selling process all over again. And so you kind of have to make this decision as to if you want to negotiate how much, or do you want to just walk away from the deal, or do you want to accept the deal as is? In addition to getting your own private property inspection, you also want to consider having the city come out and have them do a city inspection, because most cities require you to register your property as a rental. So you're going to have to work with the city hall and tell them that you want to rent this property out, and they typically are going to come out and do their own inspection and make sure that this property is livable and there's not any major issues. If you do a private property inspection, you should find all the major issues, but the city might tell you something that you didn't expect, or they might make you do things that you didn't know you had to do. So you want to talk to the city early on, and you want to know exactly what your costs are going to be before you actually buy the property. That way you can do your financials and your numbers based on what your actual costs are going to be. So before I buy a rental property during this due diligence period, I do 3 things. First, I get my own private inspector to go out and walk through the property and tell me what's wrong with it. Then I like to have the city come out. That way the city can tell me what I need to do to get this property licensed for rental. And third, I'm going to have my contractor go through the property. That way I can show him a private property inspection, the city inspection report, and then whatever renovations I want to get done. That way I can see what my total costs will be to get the property renovated and ready to go before I actually buy the property, so I can look at the numbers. Now, one little caveat I want to give you is anytime you get renovations done, chances are it's going to cost you a little bit more than what you expected. So just kind of budget that in there and understand that, because almost always you're going to pay more than what you thought to do the renovations. Once you find a property that passes your due diligence, now you got to get the cash to actually buy the property. This isn't something that you want to start after you enter into contract to buy the property. If you're talking about getting financing or getting cash, you got to know how you're going to get the cash to buy the home before you even start looking for homes. But now is when you got to get serious and actually get the cash to buy the property. And when it comes to getting the cash, there are 3 ways that you can purchase real estate. You can buy a property all cash if you have enough money in your bank account. You can use equity partners. So if you want to buy a $150,000 property, you and 2 other people might front $50,000 each, and now you 3 are equal partners in this property, and you're going to share in the profits, in the rental profits, and when it comes time for you to sell the property, assuming that you make any money. And then you can use debt, where you can borrow money and pay this money back plus interest. And the way you can get this debt is through a bank, or you can do a land contract, which is when the seller of a property gives you the cash to buy their home. If you're like most people and you don't have all the cash in your bank account to buy a property, then you're gonna have to do one of these 2. And these are 2 things that you wanna start preparing for before you actually start looking at properties, because you wanna make sure you have the cash ready when it comes time to actually close. Like if you're gonna go get debt and you wanna borrow this money from a bank, your bank is gonna wanna see your income statements for at least the past 2 years so they can see that you have stable income. They're gonna wanna look at your credit score. If you wanna get the best rates, you wanna have a minimum of a 760 credit score, and they're going to want to see your experience and your reputation. So the bank wants to see that you are a safe investment for the bank's money. A land contract, on the other hand, is when you want to buy this property right here, and you tell the seller, okay, I want to buy this $150,000 property, but I can't qualify for a loan. Either I don't have a good credit score, or I don't have enough income to show the bank, or whatever. I can't qualify for a loan from the bank, and so I will give you, the seller, $10,000 today, and in exchange, you hold back a note, a loan, for the remaining $140,000. So the seller will only get $10,000 today. That's what you give them. And then every month after that, you're going to pay the seller interest on this $140,000. And so the term typically on a land contract is usually 5 to 10 years. It's not usually a 30-year term like you see with banks, because these sellers want to get their money. And the interest rate you're going to pay on a land contract is typically higher than what you're going to pay if you got a loan from the bank, because the seller understands that if you could get this money from a bank, then you wouldn't be asking the seller for a land contract. So a land contract is an easier way for you to get money, but you got to pay an extra fee for it. And one thing that people like to do is maybe you can go buy this home, use a land contract to get it, and then once you're ready, you can go to the bank, refinance this home. That way the seller can go out of the picture, you pay off the seller, and now you're paying this lower interest rate to the bank. But the thing you got to be aware of here with refinancing is if property values go down, then it becomes harder for you to refinance. So you just got to understand the risk. And the thing about debt that you have to understand is the more debt that you take on, the more risk that you take on. So I want to make sure you understand that when you're buying this property, you're buying cash flow, you're not just buying a headache. And so you don't want to take on too much debt. This is one of the things that people get really excited about in real estate. Is there's this whole industry of people promoting the no money down real estate, where you might do something like buy this $150,000 property where the bank is going to give you 80%. They'll give you $120,000, and they'll say get the other $30,000 from the seller through a land contract. So the seller gives you $30,000 because they don't need all that money today. You pay it off over time, and then the bank gives you the other $120,000. So you bought this property with no money down, and now hopefully you can make a profit. And if property values goes up, that's all your money. Now, while this sounds great in theory, it also comes with the most risk, because if your tenant stops paying, or if your tenant damages the property, you have no skin in the game. And if you don't have money to take care of that and to cover your costs, now you're going to be the first one to go underwater and get the property taken away from you by foreclosing on the property, because the bank or the seller is going to ask for the property back. So debt is a tool, and it can be a good thing, but too much of a good thing can be a bad thing. So if you take on too much debt and the economy slows down, you're going to be the first one to lose everything. Now, if you come to equity, this is where now you're going to have partners in the deal. There's a couple ways that you can do this. In some instances, you're going to see that you have doctors or attorneys, these high-income people who might have a lot of money but don't have the time to go and invest in a property. You can go to these people and say, hey, give me 15% equity in a deal and we'll work on deals together. So you go out, you find the properties and you manage them and you make sure that they're profitable. And this cash provider, this rich person, is getting 85% of all the profits. You get 15%. So you're managing the deal. You don't have to put in any of your own cash but you get 15% equity. Or the alternative is you find a couple partners, you want to buy this $150,000 home, you all put in $50,000 each, you're equal partners in this instance, and so every time you make profit with your rent, you guys split the profit, 1/3, 1/3, 1/3, and when it comes time for you to sell the property, you share the profits, 1/3, 1/3, 1/3. You can compare that to debt, where in this instance, let's say this property sells for $1 million, okay? In this instance, the bank and the land contract owner are only gonna get whatever money they were in contract to get. So they're only gonna get this $150,000 plus interest. They don't get any of the profit. Here with the equity holders, you only get 1/3 of the profits because you only own 1/3 of the property. When you buy a property with cash, then it's simple. You're just using your cash to buy the property. If you are a cash buyer, here's a little hack that I've used in the past that you might like. So if you want to buy this $150,000 home, what you can do is you can go to the closing table and you can buy the property for $150,000. But one thing that you can do is, let's say you're buying this property through an entity. I'm going to talk about this in just a minute. Now, instead of you depositing $150,000 into this entity and then buying this home, what you can do is, instead of you depositing it into this account, you can loan this money to your account. So now this entity that you own, I'm gonna talk about this legal entity in just a second, but you own this entity that owes a loan to you. So now when you buy this property, you still have to make loan payments, and this loan payment goes back to you. So now your real estate investment has more of an expense because you have to pay interest, but all that money is going to you. So you get a bigger deduction and the interest tax break. Now, although I am an attorney, I'm not your attorney. So if you have specific tax questions or legal questions, talk to a professional in your area. This brings me to number 6, understanding the legal side of real estate, which means you got to understand what an entity is, a real estate entity, understand real estate insurance, and having a real estate attorney on your side. So when I buy real estate, I never buy real estate under my own name. Like, I don't actually own any real estate. I own real estate companies which own real estate. So the way it works is like this. This is me, and you know, I gotta draw me a nice mustache. I own this entity right here. Let's call it JS Real Estate. So I own JS Real Estate. This JS Real Estate might own this home right here. I don't actually own the home directly, because if I own the home directly and something bad were to happen, let's say a tenant lived in here and they slipped and fell in the bathtub because they said the bathtub got too slippery when the water was on, true story, and then they sued me. If I own the property, then they'd be able to come after me and my personal assets. But if this property is owned by JS Real Estate, then the most they can get, assuming that insurance doesn't cover this lawsuit, the most they can get is whatever this entity owns. And so this entity that I have, in this case, it might be an LLC. You got to ask an attorney in your area for what's best. But in most instances, LLCs are the best way to go. This entity is kind of like a barrier or protection that protects you and your personal assets from lawsuits and anything bad going on with your property. There's a saying in the real estate world that if you are a real estate investor and you haven't been sued yet, then you haven't been in business long enough. I mean, this is just the reality of being a real estate investor, especially in the United States, because you can be sued for anything. Like, I had a tenant sue my real estate company because they claimed that the bathtub was too slippery when the water was on. True story. I already made a video on YouTube where I talked about this. If you want to watch that and learn more about what happened, I'll link that for you in the description below. But this is where you got to understand, okay, what can I do to protect myself? That way I can protect my personal assets. And the way you can do that first is by creating this legal entity. The second thing you want to do is have real estate insurance. This real estate insurance is there kind of as the first shield before the entity, because this real estate insurance is there to protect you from anything bad happening. Like if a tenant slips and falls, or if the tenant sues you, first thing they're going to do is go after your insurance. So this insurance is there to protect you from lawsuits, and it's also there to protect your property, because if this property gets burned down or something bad happens to the property, that's where insurance is there to protect your assets. So insurance is your first line of defense. If the insurance fails, or if they don't cover you for whatever reason, this is where your entity is your second line of defense to protect you and your personal assets. The third thing that you want to make sure you have on your side throughout the entire real estate process is a real estate attorney. From the minute you start negotiating deals in real estate, you want to make sure you have a good real estate attorney on your side, because they're going to help you review your purchase agreements. They're going to help you review your due diligence. They can help you negotiate the contract with your contractors, and they can help you deal with city inspectors. You need to have a good real estate attorney on your side. I know they can be expensive, but it's a small price to pay today that can save you a huge headache in the long run. You want to make sure you have a good attorney that specializes in real estate. You don't want to just get a general attorney. I'm telling you this from experience because I am an attorney. There's a lot of kind of complexities and little things involved in real estate. So you want to make sure you have an attorney who's very familiar with real estate, not just a general attorney, because they can protect you from huge headaches in the future. Now, moving on to number 7. Once you get this property, now you want to start renovating it and get it rent ready. But you want to make sure when you're renovating it, you're getting a good return on your money, because you just don't want to throw all your money into these fancy renovations if they're not going to pay you any more money. So the first thing you got to understand is what sells a home, or what gets a home leased out. That's kitchens and bathrooms. If you do decide to make upgrades in a rental property, those are the two places that get a lot of attention, kitchens and bathrooms. So if you do decide to make renovations, look at doing things there. The next thing you got to look at is the durability of your property, because if you have tenants moving in and out of your property over the years, then you want to make sure that the renovations that you do can last you for a long time, because the last thing you want to do is constantly keep having to repair and maintain a property every time a tenant moves out. So one thing that I like to do is have minimal or no carpet at all in a property. A lot of my rentals actually have this thing called laminate vinyl planks on the flooring, which is something that looks kind of like hardwood, but it's not hardwood, and it's also waterproof, so it's durable. And unlike a carpet, I don't have to replace it every time a tenant moves out. So it's easy to clean, easy to maintain. It costs a little bit more in the beginning, but it saves you a lot of money in the long run because it's durable and it looks really nice. In the kitchen, one thing that I like to do is upgrade the appliances. I like to put in brand new stainless steel appliances because people like appliances they're going to be using a lot, and stainless steel looks nice. And if you take care of your tenants and you make them feel at home, then they're going to take better care of your rental property, and they'll be more likely to stay there for longer. An easy way to understand the level of renovations that you need to do in your area is just by walking through other rentals in your neighborhood or in your city around your property. That way you can see what other real estate investors are using, because the last thing you want to do is put in super expensive granite countertops when people are not willing to pay for granite countertops in your area. So just walk through a few rentals and see what people are putting in and see what people are charging for rent. Remember, your goal is to make money, and so if you're doing renovations, you want to make sure you're getting a good return on the renovations that you're putting in the property. Now, once you got the property renovated, it's finally time for you to rent it out and start making money. Now, you can rent out the property yourself and you can show the property and do all that, or you can use a property management company or a real estate agent. I recommend using a property management company. That way this whole process is automated and passive. I'm going to talk about that in the next step. But if you do decide to rent the property out yourself, you got to understand what you got to look for when you're trying to find a tenant. Because when you find a tenant, the last thing you want to do is you find somebody who says, hey, can I move in tomorrow? And you tell them yes, and then you just move them in and have them sign a lease. Because typically what you see happen is somebody who wants to move in immediately is also the person you got to kick out very fast. You got to do your background checks on tenants. So you can look at their credit score, you can look at their criminal history, and you can look at their past rental history. Typically, I don't really care too much about someone's credit history because there are so many things that can negatively affect one's credit score. I want to look at now your income, how much money you're making, are you consistently making money, and what is your past rental history. So I will call, or I'll have a property management call your previous landlords and ask them how you were paying. Were you paying on time? Did they have issues with you? If you're paying on time and you don't have a great credit score, maybe you went through a divorce or something else, then it doesn't matter as much. I just want to see, are you making enough money to support this rent, and are you going to have issues paying this rent 6 months from now? If you use a real estate agent or a property management company to rent out your property, typically they're going to take 1 month's worth of rent as their commission for leasing out the property. This is a fee that they take in addition to their monthly fees. So just factor that in, because if you have an agent or a property management company do this and you're charging $1,000 a month, they're going to take the first month's rent, $1,000, for getting your property leased. If your goal is to be a real estate investor, a true real estate investor, then you shouldn't be spending all of your time managing your real estate. Your job and your time should be spent finding more real estate investments and finding more real estate deals. That's why I don't manage any of my properties. I have a property management company that does all the day-to-day work. They find my tenants, and I don't even know who my tenants are. All I see is a report every single month which shows which properties are paying what rent and what the rental income looks like and what the expenses are. A property management company's job is to make your real estate investment passive for you. So they're going to take a fee every single month, typically somewhere between 4 to 10% depending on how many properties you have, and then they're going to charge you 1 month's worth of rent to list out your property, which is why you want to have tenants in your property for as long as possible. That way you don't have to keep paying that listing fee. But this real estate property manager's job is to really make it easy on you, because after you find the property and you get it renovated, you just want to hand over the keys to the property management company and let them do their job, find the tenant, and make sure that you get paid. A good property management company is going to know how to screen a tenant. They're going to have contracts and deals with a lot of contractors. That way you can save money on your renovations, and they're going to pay all your bills. They're going to pay your property taxes. That way all you have to do every month is just read your reports and see how much money you're making and let them handle all the work. I think every new real estate investor kind of goes through this phase where they're thinking, okay, I'm going to make $1,000 a month from this property, but why do I want to pay this property manager $100 a month or 10% of the deal? I could keep the extra $100 a month in my pocket if I just manage it myself. Yeah, you could make the extra $100 a month if you manage the deal yourself, but now you got to spend the time managing the deal and making sure that all the bills are paid and making sure that your tenant is paying rent. If instead of worrying about making the extra $100 a month, you worry about how do you create a new rental property and make a new stream of income for $1,000 a month, then the $100 a month expense doesn't seem so bad. So I want you to think about growing the pot, not just worry about how you can stop saving these expenses, because you as an investor don't want to be caught up in the game of managing. You want to be caught up in the game of how do you find more investments and how do you create more real estate deals. You want to think bigger, not just smaller. Now, you got this property, you've been renting it out, it's cash flowing, it's making you money every single month, and now let's assume it comes time where you want to sell this property and you want to cash out, because let's assume that you bought this property for $100,000 and let's assume that now it's worth $1 million. So now you have all this equity built up on this property and you don't want to refinance out of this property. You just want to sell and you want to be done with it. The advantage of you being a real estate investor is there are certain loopholes that you can use, legal loopholes, to sell this property and not pay any taxes right now. So this loophole is called 1031. It's the 1031 exchange. And essentially what it says is if you sold this property today for $1 million, then you'd have to pay taxes on your profits, in this case $900,000. Instead of you paying taxes on $900,000, which would be a lot of money, what you can do is you can take all of this $1 million and you can take this $1 million and use it to go out and buy another real estate investment property, a bigger property, and now you don't have to pay any taxes on your profits today. So you invested $100,000, this property is now worth $1 million, now you go out and buy $1 million property and you don't have to pay any taxes on your profit, and now you got more income coming in because you're not having income on a $100,000 property, you're having income on $1 million property, and so you can have more cash flow, more passive income, and you don't have to pay any taxes on your profits. This is not something that you can do in the stock market. If you invested $100,000 in the stock market today and your investments go up to $1 million and you sold it and you use this $1 million to go and buy new stocks, that might be a good investment strategy, but you still have to pay taxes on your profits. So while you invested $1 million, you still have to pay taxes on your $900,000 worth of profits. So if you don't have the money in the bank, then you might have to sell some of your stocks, that way you can pay your tax bill. You don't have to do that in real estate because of this loophole 1031, which lets you flip real estate and now you can own bigger real estate without having to pay any taxes on your profits. Plus, there's no limit to how many times you can do this. Like if you bought this property for $100,000, it goes up to $1 million, and you sell it and you buy $1 million property, then you can take this $1 million property, sell it, and you can use your profits to go out and buy a $2 million property, and you can do that again and again and again. So there's no limit to how many times you can do 1031, which can allow you to compound your wealth, because I'm sure you've heard of compound interest, and you don't have to pay any taxes, which could eat away at your wealth if you keep doing 1031. If you do decide to do this, talk to a real estate attorney early, because there's a lot of kind of little rules and details you got to follow in order to do 1031 the right way, and you don't want to accidentally get caught with a surprise tax bill. So make sure you talk to an attorney, because if you want to do this, you want to make sure you do it right. Before we get into the next clip, if you are interested in learning more about how you can manage your money the right way, that way you can build wealth, have a financial system, and invest your money, our team put together an amazing guide that walks you through how to do this. You can download this guide for free when you sign up for our daily newsletter, and you can do that by clicking the link up here or by clicking the link in the description below. Cryptocurrency, Bitcoin, Ethereum, Litecoin have been very popular recently with their run up in price, and then Elon Musk coming out talking about how he's buying Bitcoin for Tesla, and then you have PayPal and Square buying Bitcoin, and so cryptocurrency has been very popular. And naturally, a lot of people have been trying to get into cryptocurrency, hoping that this would be an easy way or a quick way for them to make a lot of money, or at least protect their wealth. But a lot of people are buying cryptocurrency without knowing what they're doing. I don't know how today's numbers compare to the 2017 numbers when the 2017 Bitcoin and cryptocurrency crash happened, because back when that happened, it felt like everybody was buying Bitcoin, and it also felt like nobody had any idea of how cryptocurrency worked or what cryptocurrency even was. There's definitely a lot more awareness and knowledge as to what cryptocurrency and Bitcoin is now than there was a few years ago, but there's still a lot of uncertainty as to what cryptocurrency is and how Bitcoin is going to work in the future. And really, what is a good valuation for cryptocurrency? Kind of as a really brief backstory, the whole idea behind Bitcoin and cryptocurrency originally is that it is supposed to be a decentralized, worldwide digital currency. And I'm going to explain what that means in just a second. But before I do that, I need you to do me a quick favor and smash that thumbs up button below. So a decentralized, worldwide digital currency means that first, this cryptocurrency is supposed to be a currency, kind of like our dollars. That way you can use this currency to buy and sell things. And so the whole idea behind it being decentralized is it's not controlled by one government. So it's not like you're spending dollars in the United States and pesos in Mexico and rupees in India. It's Bitcoin all around the world, whether you're in America or Mexico or India. So one Bitcoin all around the world is the same as one Bitcoin, because $1 is different than one peso, and one peso is different than one rupee, right? So Bitcoin is supposed to be decentralized, where it's this uniform kind of currency all around the world, and it's worldwide because you can use it all around the world. And it's a currency, or supposed to be a currency, because the whole idea is you should be able to use cryptocurrencies like Bitcoin to buy and sell things. So decentralized, worldwide, digital currency. I guess I skipped digital. The whole idea behind it being digital is you don't own anything physical. When you have a dollar in your hand, you have a physical dollar. Whereas cryptocurrency is a digital currency. So you don't have anything in your physical hand except maybe a phone where you can access your digital currency. The reason people have been flocking to things like cryptocurrency and Bitcoin is because, for one, you've seen all this money printing happen. And when all this money printing happens, our dollars, our US dollars, get devalued. And when that happens, we see more inflation, and the vast majority of people become poorer. Cryptocurrency, on the other hand, has a finite number, at least Bitcoin does. There is a maximum number of Bitcoins that can be created, 21 million Bitcoins, and after that, you cannot create any more Bitcoins. And so you cannot create the same inflation, in theory, with Bitcoin the same way you can our dollars. And so people like that about Bitcoin because it is a way, or supposed to be a way, for you to protect your wealth. The second reason why people really like cryptocurrency like Bitcoin is because it kind of steps you away from the control of a central government, because when the government controls the monetary supply or the money supply, they have a lot of control over you. But if now your monetary supply is controlled by the users of the money, because that's how Bitcoin works, then you don't have that same control by a central government. Now, obviously, that's also one of the big challenges of adopting cryptocurrency like Bitcoin, because no central government wants to lose their control over the money supply. And so that makes it a little bit harder for cryptocurrencies like Bitcoin to get fully adopted the way they are, because no government wants to lose their control over money. The third reason why people really like cryptocurrency like Bitcoin is because it's finally starting to get adopted. Like Elon Musk and Tesla bought more than $1 billion worth of Bitcoin to add to their portfolio, and Stripe and PayPal have both added Bitcoin to their platforms. And so you're slowly starting to see Bitcoin start to get adopted into these tech companies, which is kind of a sign that maybe over more time, you're going to see cryptocurrency become very common in how we do transactions. This gets people very excited, because now people are thinking, whoa, Bitcoin and cryptocurrency is finally starting to get adopted. And if more tech companies start to get behind the trend and they start to use it, that means other companies will start to use it too, the more traditional companies. And when that happens, then everybody's going to be using cryptocurrency and Bitcoin. And if I can come in now and I can own some of this cryptocurrency, then it's going to be way more valuable in the future, because there's a limited amount of Bitcoin in the world. And so if I own some Bitcoin, then it's going to become way more valuable, because there's going to be so much more demand for it and not that much supply, because there's a limited supply of Bitcoin. So I'm going to be rich. And this brings me to the fourth reason why some people like cryptocurrency like Bitcoin, because they think it is a way for them to get rich quick. Going back to some of the things that I just talked about, a lot of people feel like they're being screwed over by the system, because you're seeing this bigger divide between the rich and the poor. We have all this unemployment. We have all these businesses that are being shut down. We have all these jobs that are being lost, and people feel like they keep getting screwed over by the system. And so they're turning to cryptocurrency and Bitcoin kind of as that solution, because now this is a decentralized, or supposed to be a decentralized currency, where now if you can get in before everybody else, then this will be a way for you to get rich, because everyone's going to come in and buy. But anytime you start to see people buy things, not for the purposes of using this thing, but for the purposes of just getting rich quick, that's always when you should have some red flags going up. There is real value behind cryptocurrency and blockchain because a lot of people are already used to digital currencies. I mean, when you swipe your credit card, are you really using real money? You're just swiping a piece of plastic where now a couple of digits move from your bank account to someone else's bank account. And so people are already kind of used to digital currency, although a lot of people don't think of it as digital currency, but people like the idea of not having to carry around physical cash and having a decentralized currency where now you can go around the world and spend money without worrying about conversion rates is just convenient. And blockchain is the technology that kind of fuels cryptocurrency because blockchain is the technology that secures financial transactions and it secures data and it makes it nearly impossible to hack or cheat this data. And so this technology has its own value because it can change the way that we spread data and do financial transactions in the future. Now, in this video, I'm not going to be going into how you can actually buy Bitcoin and store cryptocurrencies like Bitcoin in this video. If you want to learn more about that, our team put together an amazing article that goes through exactly how you can do that on our website, theminoritymindset.com. So if you want to learn more about that, I'll link that article for you in the description below. So there is a lot of value and power in this technology, and if anybody tells you that there isn't, then they just don't understand how cryptocurrency and blockchain works, but there is real value and power in this technology. But the thing that is concerning is that according to the survey, you have a lot of people that are buying Bitcoin and you're buying cryptocurrencies without knowing what the heck they're doing or what the heck they're buying. A third of buyers have zero knowledge about the entire cryptocurrency space. So why are they buying it? Because their friend or their cousin Bunty told them, yo, if you want to get rich, buy Bitcoin right now. And so that's always concerning because now you have people buying a product or buying this technology, not because they want to actually use it, not because they might actually believe in it, but just because they want to get rich quick. And this article even mentions that. It says that 1 in 4 cryptocurrency holders told Cardify that they were entering the cryptocurrency space in the hopes of earning short-term financial gains. In other words, 1 in 4 people told Cardify, so these are people that are very open and honest about it, 1 in 4 people told Cardify that they're buying cryptocurrency. Why? So they can get rich quick. Yeah, that's just me translating what short-term financial gains means in real English. So what does this mean? Why does it matter? Well, anytime you see people start to buy something, not for the purposes of believing in this thing or not because they believe in the fundamentals, but just because they want to get rich quick, these are more of your emotional buyers or investors, whatever you want to call it. And so as things are going up, you're going to see more of these emotional people coming in and buying because they want to get rich quick. And then if this asset class starts to come down, these are the first people to sell because they were just hoping to get rich quick and they don't really understand the real fundamentals. They don't really understand the real value. And so when things come down, they're the first to panic sell because they see their portfolio in the red and they don't understand what's going on. And so this causes a lot of volatility. That's why you see such huge drastic rises and huge drastic falls with cryptocurrencies like Bitcoin, because you have so many people buying it, not because they believe in its value, but because they just want to get rich quick. Now, if I'm just being practical, you have a lot of people that have gotten very rich quickly because of Bitcoin. And so there are ways to get rich through a bubble. But you just got to understand that there are a lot of risks involved as well, especially if you're looking for the short-term gains, meaning they're trying to get rich quick, because if things turn around and you're holding on to a big position, especially if it's leveraged up with debt, because you have a lot of people buying cryptocurrency with debt. And so if you have this highly leveraged position and you were just hoping to get rich quick and then things turn around, well, now you're going to be the first one to lose everything. And because there have been so many new millionaires because of cryptocurrency and Bitcoin, and because it's such a new technology, and because so many people are trying to buy Bitcoin and cryptocurrency hoping to get rich quick, you have a lot of scams around cryptocurrency and Bitcoin. I mean, you see it all over social media. On YouTube, every big financial YouTuber has all these scammers trying to get your money into these cryptocurrency scams, so beware of scams in the comments. You see it on Instagram, you see it on Facebook, you see people just trying to solicit other people's money to buy cryptocurrency when actually people are just taking their money and running. And again, this is why it is so important for you to make financial decisions, not emotional decisions, because when people are so charged up and so riled up and trying to get rich quick, and this is especially fueled with easy debt, that is when it's so easy for people to get caught into these scams, to get caught into these schemes where now you're losing everything because you were just hoping to get rich quick and somebody was promising it to you. Again, there is real long-term value with cryptocurrency and blockchain. Okay, I'm not trying to discredit that. There is real value here. And so you now, as somebody who is trying to protect your wealth and is trying to protect your money, you just got to understand what's going on, and you want to make sure you're making your financial decisions financially, not emotionally, because the people that make the most money over the long term are the people that make their financial decisions, not emotionally. And so now just remember that, because as more and more companies get behind cryptocurrency, you're going to see more hype and more excitement behind it, and you want to make sure you're making your decisions rationally. If you enjoyed this video, here's a video on building wealth that I think you'll love, and while you're at it, join our free finance and business newsletter, and as always, keep hustling. The more you have, the more you can do. So if you want to be able to help more people, you got to understand how wealth plays a part in that, because if you have the money and you have the resources, you can do a whole lot more good for yourself, your family, your community, and your surroundings.